Inflation and recession sound intimidating and difficult to understand. Leave it to the economists and the government to comprehend it, right? Remember, knowledge is power. Being in the know is part of your journey to wealth and financial freedom. Interest rates and stock market sound technical. You'd think these are matters that only experts and men in sleek suits should concern themselves with when, in fact, these are among the things that affect the economy, which, in conclusion, affects you. The Federal Reserve increased the funds rate by 75 basis points to 1.5% to 1.75% during its June 2022 meeting instead of 50 basis points initially expected. Rate hikes could continue in 2023, with the median projection from the committee members raised to 3.8% for the end of 2023, up from 2.8% in March. Given the increase in share of household wealth, which hit a 41.9% record by the end of 2021, the stock market's impact is increasingly significant even if it isn't the entirety of the economy. Don't see yet how all of this plays out in your life and in your journey to wealth? Well, continue watching to find out. Hi, welcome to the Wealth Monopoly. Today, we'll give you a crash course on hyperinflation and recession. Will recession put out the fire of inflation, or will it just fuel the fire? We'll teach you about what exactly is going on with our economy and what to expect moving forward. An understanding of this is crucial in your journey towards wealth, so listen very carefully. With months spent at home, unemployment insurance, and government help, Americans found a temporary breather from money worries during the pandemic. Now that the pandemic has been relatively handled, another problem has peeked its mischievous head out. Rent has increased. Gas prices are at an all-time high. Prices for goods are painstakingly high. These are just among the many things that make people scratch their heads and groan loudly in frustration. Inflation has caused so much financial stress. As of June 2022, the U.S. inflation rate has risen to 9.1%. The savings that had been accumulated during the early pandemic financial relief have completely drained by now. People are back to the paycheck-to-paycheck life. Are we really trapped between inflation or recession? Is it just really A or B? Might there be an option C or maybe even D? The inflation rate is higher than it's been since the early 1980s. Now, inflation is America's top problem and a top domestic priority. The battle against inflation has triggered the risk of recession. Although there is a prospect that recession could extinguish the inflation fire, this is not guaranteed. Firms have exercised their pricing power with a heavy hand. If a recession fails to properly reset prices to its pre-pandemic state, then it introduces the risk of stagflation. In the 1970s, stagflation was a combination of high inflation and slow economic growth. It was a structurally broken economy. This involved high long-term interest rates, hampered monetary and fiscal policy, and sustained elevated unemployment rates. All of these together are much worse than elevated inflation and slow growth combined. Because the cost of living has increased drastically, people are forced to minimize their budget as much as possible. Because of that, they spend less, therefore lessening demand. Hence, prices lower as well. To put it simply, stagflation is something you should be worried about. It's a sign that things have officially gone haywire. COVID inflation was a convergence of high demand caused by enormous stimulus and supply bottlenecks. Later came a scramble for labor, the war in Ukraine, and an economic lockdown in China. Inflation is unpredictable. Realistically, inflation will stay above the target rate of 2% throughout all of the next year. Despite that figure, ready yourself for unexpected shocks. Hey, I know that sounded like impending doom, but hang in there. By the end of this video, you'll understand why you don't have to freak out at all. But before we continue, please give this video a thumbs up. Feel free to leave your thoughts, ideas, and suggestions in the comment section below. Let's resume with a bit of good news. Supply chain issues contribute greatly to the inflation problem. The supply shortages have been resolved with the recovery of industrial output and increase in imports. However, we have to note that our necessities travel a long way before getting to us. The transportation of these goods is costly, so you'd see how it accumulates value and therefore gets more expensive once it reaches you. Don't forget that profit margins and salaries are also accounted for. Inflation has served as an opportunity for companies to mischievously exercise their pricing power. But really, these big men are playing with your expectations. When there's talk of inflation, you'd expect prices to increase, right? These companies ride on those expectations, so once they actually increase prices, you won't be too surprised to complain. Inflation has also given workers a louder voice in the company. Demanding a pay raise to keep up with the inflation sounds reasonable and convincing. The Federal Reserve is attempting to dampen the situation by increasing interest rates. This will weaken business activity. It will slow down wage increases and maybe even lead to layoffs. It could also stop prices from rising so that demand could be dealt with accordingly. The government could simply pronounce inflation as a top priority, therefore planting a public expectation that this matter will be solved quickly. In effect, people will lose the motivation to act in a manner that will lead to inflation. They have to be careful about this strategy, lest they lose public trust. When inflation is high, the next level to be reached is recession. To address this, the government lessens taxes while spending more. Meanwhile, the central bank decreases interest rates. Remember, what fixes inflation does the opposite for recession. So what is the best course of action? A compromise is the best way to go. The government allows the feds to do its job while they release new stimulus measures. But wait a second, isn't that what caused inflation in the first place? This time, it's different. These stimuli are constructed to increase supply of goods and services instead of demand. The targets are infrastructure building and housing as well. The goal is to gradually diminish prices while effectively providing economic stimuli. In a sense, we are wedged between inflation and recession. But hey, don't freak out just yet. Reserve banks are on it. They are taking purposeful measures to resolve the situation. Employment is still at a strong stance, so people still have a paycheck to live off of. The stock market isn't at its best this year, but let's look into it. Overvalued tech companies are what pulled the market down. Companies involved in traditional businesses have flourished still, so it wouldn't hurt to invest in them more. The US has experienced 11 economic downturns since 1948. Hopefully, this has made us more alert so that we wouldn't be as shocked by the impacts of either inflation or recession. Hang in there, buddy. Economic jargon isn't reserved for economists, the government, and the fancy-clad Wall Street men. What happens in the economy affects you just as much as it affects them. Being well-informed pays off, literally and figuratively. As always, we are with you on this journey of wealth and through the different highs and lows of the economy. Please subscribe to our channel and ring your notification bell so that we could continue to be on this journey with you. See you in the next video.